viewers. I'm Hiral Tadia. I think today is not a day to actually discuss any strategies in the commodity market with the kind of mayhem that we've seen in the equity markets alone. Clearly, if you see the last 1 month or the last 2 months as well for the commodities market, we've seen a decline of almost around 50 to 20% in the base metal space and almost a 20 to 25% decline in terms of crude prices. Now, what is leading to this decline? Because one thing that Kunal was just pointing out right now to me is that the declines are coming in with a lower base, and that's something which should be worrying. Kunal, first thing, a 15 to 20% decline on metals in the last 2 months, a 20 to 25% decline on crude, and as you just mentioned, the declines are coming in from a lower base. Is this something to really worry about at this juncture?
Yeah, it is definitely something to worry about. During the start of this fall, it started with the reason of coronavirus crisis. So, because of coronavirus crisis, so what is the total death figure as of now in the world, and how many people dies during the day? So, I think that number is not that significant. It's just the fear factor which is adding to the vulnerabilities in the market. But the fact is that there has been a major divergence in the real economy and in the markets. So the real economy, you talk about the G4, G5, there has been a constant decline in the growth of the manufacturing and also the growth, GDP growth rate were coming down. In US also, the business spending was going down, consumer spending was remaining weak, and despite of all this thing, Dow Jones was making new high. But what changed dramatically, coronavirus crisis became a medium just for markets to actually realize that this fall is more of a fundamental fall rather than just fall in.
It's not a technical fall.
It's not just the coronavirus fear fall. There is a lot of thing happening in the global market. The best example right now is central bankers have been trying to prop up the market from last 10 years. And they have been successfully doing that, and they have been rewarded. But what is happening is, so in last 3 to 4 days, what we have seen is Federal Reserve cutting rate by 50 basis points. We've seen a Bank of Korea, we've seen Bank of Australia. All the central bankers have started to cut the rates. And again, there was a conception in the market that look, since the central banks are again pumping liquidity, the markets are going to go up again. But it's not working anymore. The fact is, the monetary experiment by the central bankers is not welcomed by the markets anymore. Today, as of now, when we are talking, US 10-year bond yields are down by 17 basis points. So this is not something normal phenomenon. And if you look at the 30-year tips of US, that is 0%. So it is even below the equity dividend yield of US. So what this is indicating towards a point that we are heading towards slowdown or perhaps a recession going forward, and the complacency in the market that the liquidity will again prop up the market and again.
So I'm going to interrupt over here, Kunal. We're talking of a crisis situation.
Yes.
We're talking of a slowdown.
Yes.
We're talking of a recession.
Yes.
There is a very thin line between all the three, especially if you have to talk about a temporary slowdown or a recession. The current stage, is it still pointing to a temporary slowdown? Are there any chances of revival that could come through if there is any positivity, or if this there's a possibility that this continues and we get completely into a recessionary mode?
I think not immediately, but during this year somewhere, I think US, Europe, these two economies can go to recession. The reason for that is very simple. The monetary experiments are not working for anybody right now. So in last couple of days of fall, globally, $8 to $9 trillion of wealth has been destroyed in the equity market. The quantum of money printing or the quantum of rate cut is not going to revive the economic growth. It can inflate the asset prices like it used to do. But the fact is that the market participants are realizing that this kind of experiment is not actually going to revive the economic growth. And that's where the capitulation is taking place. And that's why, irrespective of what positive or whatever positive statement are coming from central bank or action are coming from central bank, the markets are not halting. There is a free fall across. And that is precisely the reason the gold prices are continuously moving up. So in our yearbook also we discussed that it is a strategic investment, and I believe that forget about the price, it's about the value. So if things are really not working here, then gold prices can go up and shoot and test levels of $1,750, $1,800 in a matter of 6 to 8 months. So yes, we are in a crisis mode, and rather than realizing later, I think one should acknowledge it right now, and we are going to see that gold prices are going to shoot up further, and there is no more positive news.
Right now, there is no more positive news over here. A couple of other things that I want to discuss over here is even in terms of crude. We've already said that 20 to 25% is the kind of cut that we've seen in crude prices over the last 2 months. You have the OPEC meeting. They are waiting for Russia to respond right now as to whether they agree or they don't agree to their decision. Do you think that can have any temporary impact?
Any production cut with the magnitude of say 5 lakh barrels is not going to be helpful at all. This market is going to be in a major glut of more than a million or more than 1.12 million barrels. The state of the global economy is fragile. No matter what OPEC does, I think oil prices are going down further. So there's not going to be any stopping. Earlier I was of the view that WTI should not go below 45, but I think it can break 45 and it can still test levels of 42, 41, and for the Brent it can test levels of 45 to 46 in days to come.
Right. And very lastly, Kunal, if you have to not talk from the commodities point of view, if you have to look at metals from the equity point of view, what's the sense that you're picking up?
Well, basically metals, you will, what happens generally when the supply chain disruption take place. So, for example, in China, the manufacturing activity, the factories were halted for almost for 3 months. So now what happens is that the inventories keep, the pile up of inventories keep taking place. So the glut of 2.5 to 3 months is a very big drag on the entire metal market. So we are not going to see any structural upside in the metal prices. You are going to see whenever some positive news comes or people, Bank of China try to prop up the economy or come up with some stimulus, and you see some upside, it will again go down. So the structural view of metals is still not
it still
weak.
remains weak.
Yes.
Right. All right, Kunal. Thank you for joining in. So that's the view coming in terms of where the commodity prices and the commodity market is concerned. Clearly, as Kunal has been mentioning, it is a crisis situation. It is a slowdown, probably moving towards a recessionary phase as well. And in this entire environment, the best place strategy remains with gold, where there is some bit of positivity over the next 6 to 8 months, where majority of the investors have been shifting to gold as a safe haven. Thanks for watching. For more updates, you could subscribe to our Nirmal Bang channel on YouTube and follow us on Twitter, Facebook and LinkedIn.